Hello, myself Professor Swati Modi. I am going to introduce you to the topic financial management. The management of finance and various financial activities concerning the planning, utilizing and controlling of financial resources is known as financial management. Without finance, no organization can run efficiently. For the successful implementation of plans, finance is required. Financial management deals with procurement and utilization of funds. Though there are various functions like production, marketing, human resource, but finance function assumes an important place. Finance function deals with three important activities, namely raising of funds, investing of funds in different kinds of assets and disbursing the returns in the form of dividends. So, the decisions are the financing decision, investment decision and dividend decision. According to Solomon 1978, financial management is concerned with the management decision that results in the acquisition and financing of long-term and short-term credits of a firm. Financial management deals with the situations that require selection of specific assets as well as the problem of size and growth of an enterprise. The analysis of these finance decisions is based on the expected inflows and outflows of funds and their effects upon managerial objectives. According to James C. Van Horne, 1972, financial management as concerned with the acquisition, financing and management of assets with some overall goal in mind. No activity can be undertaken without some objectives. So, let us discuss the objectives of financial management. The most important objectives of financial management are profit maximization and wealth maximization. Profit is essential for any economic activity. It is a yardstick for economic efficiency. Profit maximization means that either the firm should produce maximum output with the given input or uses a minimum input for the given output. When we talk about profit maximization in financial management, the profit maximization objective implies that the investment, financing and dividend decision should be taken in such a way that it maximizes profits. But this profit maximization objective has certain limitations. It is an ambiguous concept. Profit maximization has different connotations for the word profit. Some view it as return on investment, return on assets or profit before tax or profit after tax. There is no clarity as to which profit is to be considered. The other limitation with which this objective suffers is that it ignores time value of money. It does not take into consideration the returns received in different periods. It treats all the returns at par irrespective of when they are received. Let's understand this concept with an example. Return received of rupees 5,000 in the first year is treated at par with the rupees 5,000 received after 2 years. This objective ignores the basic principle of financial management that the earlier the better, as benefits received sooner are more valuable than benefits received later. The profit maximization criteria does not consider the distinction between returns received in different time periods and treat all benefits irrespective of the timing as equally valuable. The one more important drawback of this objective is that it ignores quality of benefits. Quality refers to the degree of certainty with which cash flows are expected. It does not give weightage to uncertainty of returns. The riskiness associated with the cash flows is not considered. If there is too much fluctuation in cash flows, it does not have certainty and should be considered as more risky. Now moving to the other objective, that is wealth maximization. Wealth maximization talks about maximizing the wealth of shareholders. It means maximizing the net present value of a course of action or alternative. Net present value is the difference between the present value of its benefits and the present value of its cost. This objective is also known as value maximization or net present worth maximization. An alternative which has positive NPV would add to the wealth of shareholders, whereas the alternative having negative NPV would have a negative impact on the wealth of shareholders and hence not desirable. In case of mutually exclusive projects, the alternative which has maximum NPV should be adopted. NPVs of different alternatives are additive in nature. That is, NPV of A project plus NPV of B project is equal to NPV of A plus B projects. This is referred to as the principle of value additivity. The objective of wealth maximization is based on the concept of cash flows and not on accounting profits, and hence offers an unambiguous measure in making investment and financing decision. Cash flows recognize revenues and expenses only with respect to actual inflows and outflows of cash. The wealth created by the firm is reflected in the market price of shares. Market price is the operational justification for the wealth maximization. This objective considers the time value of money and the quality of benefits. It guides the management in framing policies which maximize returns to shareholders. Solomon advocated that the proper goal of financial management is wealth maximization and hence provides the basic guideline for evaluating the financial decisions. The other two important issues associated with value or share price maximization, namely, are economic value added and focus on stakeholders. Economic value added, that is EVA, determines if the proposed investment positively contributes to the shareholders' wealth. It is the difference of after-tax operating profits of the firm and cost of funds used to finance investments. A positive EVA would enhance the wealth of shareholders. Financial management concern is not just limited to enhancing of shareholders' wealth, but it takes due consideration of other stakeholders. The stakeholders include groups such as employees, customers, suppliers, creditors, owners and others who are directly associated with the company. The other objective of financial management is to provide reasonable return to shareholders of a business concern to ensure plowing back of profits for growth and expansion, to enforce financial discipline, to have the optimum capital structure and so on. Let's now talk about scope of financial management. Finance function is one of the most important functions of an organization. No matter how good you are in designing and crafting strategies, marketing and production plans and schedules, if the company does not have adequate funds, plans would remain as plans only and would never be implemented because of unavailability and inadequacy of funds, and hence the management of finance assumes a lot of importance. Though financial management has immense scope, but for easy understanding, it can be divided into two approaches, the traditional approach and the modern approach. According to the traditional approach, the financial management is concerned with the raising of funds. Funds are raised at special occasions like at the time of mergers, reorganization, restructuring, liquidation and so on, which is known as episodic financing. The role of finance function was very limited and narrow as per the traditional approach. The areas which are covered are procurement of short and long term funds, identification of sources through which these funds would be raised, legal and accounting relationships with the sources who have provided the funds, and redistribution of income and assets among these resources. This approach ignored the day-to-day management of finance and just concentrated on the suppliers of funds, making it an outsider looking in approach. It completely ignored the working capital financing which is required for the day-to-day running of the business. Since the focus is on procurement, it did not cover the allocation of funds. Traditional approach failed and was criticized as it could not answer the various questions in different facets as rightly described by Solomon. Now let's move on to modern approach. The criticism of traditional approach gave rise to the modern approach, which was definitely broader and wider. It was not only concerned with the raising or procurement of funds, but also its proper management and administration. Modern approach is mainly concerned with the three important decisions like investment decisions, financing decisions and dividend policy decisions. Modern approach was started during mid-1950s. It covers conceptual and analytical framework for financial decision making. The main issue dealt in modern approach is its matching of funds to their uses. The questions which are dealt with in this approach are: how much funds an enterprise should commit, what assets should an enterprise acquire, how the financing of funds should take place. These three questions are related to the three major financing decisions, namely investment decisions, financing decisions and dividend decisions. Now let's discuss finance decisions in detail. There are three important finance decisions as already mentioned: investment decisions, financing decision and dividend decisions. A firm should attempt to balance cash inflows and outflows while performing these functions. The decision should also try to balance the two major aspects of profitability and liquidity. The decisions should be taken in such a way that the shareholders' wealth is maximized. Now, what is investment decision? The investment decision would determine what specific assets should the firm acquire. Investment decision would also mean deciding the right mix of assets, that is, mix of current assets and fixed assets. What are fixed assets? Fixed assets are those assets which have the capacity to generate income and yields return over a long period of time. These assets involve huge investments, and investment in such assets is known as capital budgeting decisions. Examples of fixed assets are plant and machinery, land and building, fixtures, etc. Management of fixed assets is known as capital budgeting. Capital budgeting relates to the selection of asset or investment proposal or course of action whose benefit is going to be available in future over a long period of time. The evaluation of these proposals is based on a standard known as cut-off rate, also known as hurdle rate, required rate of return, discount rate or minimum rate of return. This is the rate which reflects the time and risk preference of the owners or suppliers of capital. A higher rate would reflect more risk in the investment proposal. Now let's understand the concept of current assets. Current assets are those assets that are required to support the functioning of fixed assets and which can be converted into cash within a short duration of time, that is 1 year or less than 1 year, without much diminution in value. Investment in such assets is popularly known as working capital management. If the company invests in too much of current assets, then it is emphasizing on liquidity, and if the company is investing too much in fixed assets, it is focusing more on profitability. A right balance needs to be stricken in investment policy, as liquidity and profitability both are important. Now, understanding the financing decision. The financing decision relates to when and how to acquire funds and deciding the proper mix of debt and equity and determining the firm's capital structure. Now, what do we understand by capital structure? A firm's capital structure is the mix of securities through which funds are raised to meet the financial requirement of the company. The company should try to achieve optimum capital structure. By optimum capital structure, we mean the value of the firm is maximized and the cost of capital to raise the funds is minimized. Degree of leverage would affect the capital structure of a firm. Right degree of leverage is important decision, as too much employment of debt will increase the risk and too much of equity will not allow the firm to have the advantage of cheaper source of financing. Let's understand the meaning of leverage. Leverage is the employment of an asset or source of finance for which firm pays fixed cost or earn a fixed return. The degree of debt in the capital affects the risk perception of the shareholders. It is important for the company to know from where, how much and when it should acquire the funds. The decision should result in optimum capital structure, which means it maximizes the value of the firm and minimizes the cost of capital. Now, let's move on to dividend decision, the third major decision of financial management. The dividend decision should be analyzed in relation to the financing and investment decision. The dividend decision would deal with the distribution of income and deciding the portion of earnings per share to be declared as dividends. The proportion of profits distributed as dividends is known as dividend payout ratio, and the retained proportion is known as the retention ratio. A firm should try to have an optimum dividend policy which maximizes the wealth of the shareholders. So, we have already discussed the three important decisions. So, now what is the conclusion out of this? The traditional approach had a very narrow perception and did not have an analytical and conceptual framework, but the modern approach is broad and involves the three major decisions concerning financial management, that is investment decision, financing decision and dividend decisions. Thank you.